Hi guys, welcome to Invest with George, where I look at company fundamentals and valuation. Today we're looking at Molina Healthcare, ticker is MOH. They have a market cap of 7.6 billion and an enterprise value of 7.2 billion. The company's shares trade at $148. So Molina Healthcare is a health insurance provider. Most of their exposure is for Medicare and Medicaid. They've got some coverage recently because Michael Burry mentioned them on Twitter that he is long the name. He was also long Oscar Health, I think this year or last year. So the company's shares have traded down quite aggressively. From over $400 a share in 2024 to $148 a share. And this is a very large company. They're expected to do around $45 billion in revenue this year. And over the next few years, that is expected to grow as premiums increase. The company's free cash flow could recover over the next few years. And at the moment, the management are utilizing the cash they have on their balance sheet to repurchase stock as they see their stock as having a low valuation. So let's just have a quick overview of the company. They're a health insurance company. They have under 6 million individuals on their plans, predominantly exposed to Medicaid, around 75% or 80% roughly, and Medicare as well. And also they have some small exposure to ACA, but most of their revenue they generate are from these state level contracts at different Medicaid agencies around the US. And like many health insurers this year, they've been fighting higher than expected claims costs, so medical loss ratios or medical care ratios for managed care providers, which led to multiple profit warnings from operators. So while profit is expected to go down for this year and there's been profit warnings, there's a repricing expected in 2026 where even if you have lower coverage on some of your marketplaces or through Medicare or Medicaid, because the price increase is going to be quite aggressive for next year, it's expected that this is going to allow these companies like Molina Healthcare, who's been winning state level contracts, to, even if they're not winning more contracts, the average premium paid for each individual is going up. So there's kind of a positive drift for the company's revenue and therefore for the company's profits longer term. So while they're exposed to the ACA marketplace, the market is expected to shrink next year, maybe 20%. I've seen without these enhanced subsidies, which is going to lead to a massive price increase, which could result in, like I said, a 20% shrinkage in the members on the ACA, which I think is around 24 million members at the moment, and that's grown over the last few years because of the Inflation Reduction Act. However, for Molina, their ACA exposure is quite low, and they're mostly exposed to Medicaid and CMS, which is going to be adjusting, the risk payments. Obviously, they've had higher risk payments this year, but next year, because it's so heavily regulated, CMS allows companies to write a minimum of a 15%, a maximum of a 15% underwriting profit on their plans. And so this is a heavily regulated industry, and the companies are allowed to reprice their plans. And so that's what the expectation is for next year. But overall, this is a low margin business, and there is large regulatory overhang. In terms of valuation, the company trades at a forward PE of 12, a forward enterprise value to EBITDA of 6.6, and a free cash flow yield for the fiscal year 2026 is above 11%. So the valuation is relatively cheap. The sell side price target is $170, which seems really low. So they have revised guidance for this year, and this is the most recent guidance. For roughly 45 billion in total revenue. That most of that is coming from premium. Some of that is coming from interest income from the fixed income portfolio. GAAP net income of 630, adjusted net income of 740. And you can see medical care ratios are above 90, and they have increased over the last year. The guidance is for 91.3 across their book of business. And you can see for the last 9 months ended Q3, if you look at their medical cost ratio, so this is for 2024, for Medicare it was 90.3, for Medicaid it was 90.3, for Medicare it was 87.7, for the marketplace ACA was 72.6. And you can see for this year, for the 9 months ended, how much this has increased by, especially for ACA. But across the board, this might not sound like a lot, like going from 90.3 to 91.2. That might not seem like a big increase, but for a company that produces over $40 billion in revenue, each percent is 400 million. So if you have a 2.5% move in your medical care ratio, that's over $1 billion that isn't going to the bottom line anymore. So these small movements in the company's medical care ratios or medical loss ratios makes a huge impact to the company's profitability. And the expectation is that next year, when these companies reprice, including Molina Healthcare, is that these will bring the medical care ratios, they will stabilize or come down slightly, which will allow the company to generate positive free cash flow. Another thing to mention with Molina Healthcare, and I think this is another reason why Michael Burry was looking at the name, not only are they undervalued based on future free cash flow potential, but they're also actively buying back their shares. And so you can see just over the last 4 quarters, the share count has dropped from 56.5 million shares to 52.5 million. So management see that they've communicated this to investors, that they see their valuation as very low, and they're continuing to do buybacks. I think the last authorization was 1 billion. And in these last 4 quarters, their share count has reduced by roughly 7%. So it's not a small amount. These buybacks are having a pretty significant impact on the company's reduction in share count and therefore EPS, because as you reduce the company's shares, you're also increasing the earnings per share for the following years. And share count over the last 12 months has fallen 50%. So as the year has gone on, these buybacks are having a bigger impact because the company's shares over the last 12 months have fallen by roughly 50%. So going forward now, buybacks are going to have an even bigger impact, where a 7% reduction in share count, if this continues for another year, it won't be a 7% reduction, it'll be higher than 7%. You'll have a over 10% reduction in share count, which could bring these shares down to, $46 million or $45 million per share over the next few years, depending on where the shares trade. And so buybacks, they only work when the company is temporarily mispriced and it's not a broken business model or a value trap. Obviously, I think the famous story is at IBM, who done buybacks. I think it was in the 80s or 90s where they were doing buybacks, but it didn't really translate to a higher share price. And that's because the business model was broken. They were a melting ice cube. So let's have a look at the free cash flow the next few years. So I usually do a DCF, but because of the earnings volatility that comes with insurance companies, because they reprice every year, I just wanted to have a look at the free cash flow yield, what multiple that would imply, and what the company's share price could be based on a 50 million share count. So this is the different free cash flow yields that the market is willing to pay based on the market cap of the company. So this doesn't include the enterprise value. So this ignores the company's cash and their debt. And based on the free cash flow yield, it implies a multiple that the market is willing to pay based on the company's market cap to free cash flow ratio. So you can see a 6% free cash flow yield means investors are willing to pay 16 times the company's annual free cash flow for their market cap. What I'm doing in this chart is I'm using the free cash flow estimate for 2027, which is $1.1 billion is what the expectation is for free cash flow in that year, basically in 2 years' time. And what that implies based on these yields and the multiples on the free cash flow, what the implied market cap is. So obviously, the lower the yield the market is willing to pay, the higher the multiple, the more the market cap is going to be. So you can see here, I think realistically, if in 2 years' time the company is generating over $1 billion in free cash flow and the company is growing, like I said, from this positive drift of where each member's premium costs more every year, this business ultimately, in terms of a sales point of view, is growing. And so all the company needs to do is ensure that they are underwriting at a profit and generate free cash flow. So it's underwriting discipline followed by cost discipline. So realistically, if the company is still growing and is generating this level of free cash flow, the market will probably be willing to pay, if it's the company's not growing very rapidly, maybe 10 to 11% or 10 times free cash flow for your market cap, or 9 times, in which case $1 billion, over $1 billion in free cash flow, the implied market cap is 10 to 11 billion, and the share price could be $20 to $220 per share based on 50 million shares, and that is 65 to 50% upside based on the current market price of $148 per share. However, if the company is growing, even if it's at a slow pace where it's like 3% or 5% a year, I think it's realistic at that time where you have a lower interest rate as well, where the free cash flow yield that the market's willing to pay is like 7 to 9%. I think that's super realistic. I don't think that's unreasonable to expect, where it's a 14 to 11 times multiple. At $1.1 billion in free cash flow, you have a market cap that's over 10 billion, right? So 15 billion to 12 billion. And that implies shares could be trading at over $300 a share to around mid $200 a share. And that implies, 65 to over 100% upside. And this arrow, I've put here to signify, okay, this is probably what I think is realistic. As you go down, if the market is only paying an 11 times free cash flow yield, it's because the market really doesn't think the company's going to be able to grow anymore. And that the company's business model will begin to deteriorate and they'll actually lose market share or lose free cash flow in the future. But I don't think that's realistic. So I think this is more realistic, and I think genuinely there's a chance this company could double over the next 2 years. And just to point out, the 2027 revenue expected for that year is $50 billion, right? So you've got $50 billion expected for 2027. And like I said, that's because you have a high drift from increasing premiums over the next few years. And so a $1.1 billion free cash flow margin on $50 billion is 2.2%, which is a very low margin. and it's realistic. I mean, this isn't unreasonable to assume, right? The company has over the last few years, their free cash flow margin has been significantly higher. And so this isn't a unreasonable estimate. And what's interesting is that if the market doesn't value these shares correctly over the next few years, management can take advantage because they can reduce their share count even more. So if this is realistic in free cash flow, if the market isn't giving the company a higher valuation closer to $10 billion, well, the share count will probably go even lower as the company approves more and more buybacks. So I think at the moment, not only is the valuation cheap, but also the company is actively buying back shares to take advantage of the mispricing. And I think this is a big factor to why Michael Burry is long the shares. Now, just to look at some pros and cons of this investment. So healthcare is highly regulated, and that could be a positive because the companies are allowed to write a 15% underwriting margin when they price premiums. And so you have a privatized sector that depends on government subsidies. So because constituents across the US, across different states, health insurance is absolutely vital for them. If the government doesn't provide these subsidies or support welfare spending for health insurance, constituents will vote for different politicians. So and ACA is expected to deteriorate with price increases, but with Molina Healthcare, they have very low exposure to the ACA marketplace. But even so, there's a 20% repricing in premiums. That's across ACA, and just generally for healthcare, there's going to be, even if you have lower membership in Medicare and Medicaid and ACA, because government spending is less or there's redetermination or eligibility is changing, because you have such a rapid price increase, that kind of protects these businesses. Even if you have a 10% reduction, which is aggressive, in a Molina's membership base, you're going to have over a 10% increase in price next year, which means the company is still going to be growing. And the company is taking advantage of doing buybacks at a low valuation. And depending on how long the company's valuation stays low, if it stays low for the next year or 2 years, that could actually be a really positive for this business because they can utilize their free cash flow to buy back shares even more aggressively, and that will drive an even bigger impact for EPS growth. And yeah, so like I said, if free cash flow stabilizes at over $1 billion longer term, in the next 2 years, business is extremely undervalued. Some of the cons is that historically this is a very low margin business and medical costs impact profitability. So there's some earnings volatility. This year in 2025, not all the health insurers know exactly why their health insurance costs, their medical costs have gone up. I've seen some discussion that GLP-1s have something to do with it, or at least one contributing factor. But overall, what 2025 shows is that small changes in these medical costs can massively impact the company's profitability. So there is some volatility in the company's earnings, which can be a negative. Also, generally, there is surging healthcare costs, which is potentially unsustainable for the US government. And that could prompt policy changes longer term with different administrations. But ultimately, health spending for the US government is a key spending area across all the states, right? But the problem is that because these prices could become unsustainable for the government, it could prompt them to make changes that if they wanted to say, okay, well, actually we want the companies to write a maximum underwriting profit of 5%, well, that will impact the company's upshot for their free cash flow and for their margins longer term. So the fact that they have heavy regulatory overhang is a negative for this business. Also, ACA is expected to deteriorate in 2026. Membership is anticipated to fall, maybe 20%. Obviously, I have talked about the fact that ACA exposure for Molina Healthcare is quite low, and also you have repricing. But also long term, I'd like to say that this is not a growing business organically. Like, it is growing because the average premium per individual is going up, but the company isn't always aggressively, going into new markets. They have won some new contracts with different states, but it's a competitive landscape, and a bigger contributor to the company's growth is revenue going up through higher medical costs, meaning higher premiums. So for me, I am looking at Molina Healthcare. I am looking to take a long position. I do think the shares are extremely undervalued. Remember, this is a company that's generating between $40 to $50 billion in revenue over the next few years. The company is repricing. There's CMS adjustment payments that will that negatively impact the companies this year. Repricing will allow them to offset the higher medical claims cost and allow the companies to generate a profit. Even if you have a slightly low membership or lower eligibility for Medicare or Medicaid, the average cost per individual is going up so much. There is a positive drift for the company's earnings and also their sales. I think Molina Healthcare is in a very good position, and depending on how long these shares trade cheaply for, depends on how much management can buy back of their own shares. But I think the company could easily buy back another 5 to 10% of their shares over the next 1 or 2 years. So guys, that's not investment advice. Always do your own research when investing in individual stocks. I hope this video helped you understand the valuation and fundamentals of Molina Healthcare a bit more. Thanks for watching, guys, and I'll see you in the next video.